Hello, in this video we will examine the recent issue concerning the budget agreement between the Speaker of the House of Representatives, John Boehner, and the President during the fall of 2015. This bargain would have a significant impact on the aggregate demand curve for money in the United States. After several failed negotiations between the House Republicans and President Obama, including a government shutdown, Speaker Boehner came to a fiscal agreement while preparing to end his congressional career. This agreement would provide $50 billion in additional spending in 2016, about a 5% increase, and $30 billion above current limits in 2017, as well as maintain the current 18.1 trillion debt limit until March 2017. This would avoid any possibility of a debt limit fight in November 2016, which would have been a huge partisan issue given the elections occurring during the same month. We will now consider the effects of this spending agreement in the graphs during this video. In this graph, we consider the impact of the budget agreement upon demand in the economy. This graph titled Aggregate Demand Curve Shift for the budget agreement. There are two shifts which occur in this scenario, both shifting the demand curve further right. The initial line here, AD1, is the initial point where we're beginning. Investment, or I, and government purchases, or G, would increase as a result of this economic policy. Government will be increasing spending and investment will grow as optimism over an averted debt limit fight and potentially more stability in Congress on future budgetary deals. This is shown in the graph here as demand of goods and services increases due to increased spending in the market. Economists encourage this type of negotiated deal since even the possibility of a debt default would result in a loss of trust in the U.S. economy, which has been built over decades. Next, we will look at how interest rates could change as a result of this budget agreement. In this graph titled Interest Rate Effect, Reaction and Counteraction, we show the reaction by the consumer to any changes in policy and then the government action that can be taken following consumer shifts in purchasing. In our reading, we found that the interest rate effect is the most important factor in the downward slope of the aggregate demand curve. As the economic effects of the budget agreement are felt by the public, this can lead to excessive optimism, where households and businesses increase spending, leading to increased aggregate demand and production. In other words, a fall in P, or price, reduces money demand, which lowers the interest rate, as shown in this graph here. This can lead to inflationary movement. In a counteraction, the Fed can raise interest rates as a tool to temper aggregate demand, as seen in the graph, to bring money demand back to equilibrium. The Fed can raise the interest rate, or R, by reducing the money supply, or MS, as shown here, and shifting. In these next two graphs, we're going to consider the real GDP, considering the spending multiplier and the crowding out effect on these two graphs. In this final portion, we will discuss how the budget agreement would change real GDP considering these two factors, given an MPC equal to 0.93 for the U.S. We also have as a result of the sources, we also have the 2016 increase amount of 50 billion as a factor as well. If government increases spending in 2016 by 50 billion, the aggregate demand curve will shift right by the same amount as shown in the graph at AD2 from the original AD1. The larger MPC of 0.93 means that changes in real GDP, or Y, as shown here, cause bigger consumption changes, which in turn create increased change in real GDP again. Thus, a second shift occurs when the spending multiplier is added, shifting the AD curve further right to 715 billion added to real GDP, or AD3, as shown here. In the next graph, we'll consider the crowding out effect, where the initial increase of 50 billion is shown at 82 from 81, as seen here. Expansionary policy raises interest rates, reducing the investment and the amount of increased aggregate demand. Therefore, the graph shows the reduced AD shift as AD3, reflecting the crowding out effect, where actual monetary amount causes less of an AD shift than might have initially been anticipated, and a lower increase in real GDP, or Y. This concludes this examination of the effect of real-world economic policy upon aggregate demand. I hope this has been informative for you as a viewer, and I would like to thank you for your attention.